Welcome back, folks, and welcome to the episode 3 of ICT's 2024 mentorship. So, in this video, we are going to learn about his mentorship by Wizard version. Make sure that you have given me the thumbs up and you have subscribed to my channel if you are new. And please don't forget to give me your feedback. I need your feedback so that I can improve myself for making the videos. So, let's go to the video. Here, this is my 15-minute chart, but most importantly, I need the 1-minute chart. That's why I'm going to keep this 1-minute chart only. Okay, let me make it broad here. Now, in this chart, I have this line, and that line. They are the 7 a.m., 8 a.m., 9 a.m. I have the new day opening gap. I will talk about here as well. Just give me the time, then I will talk about here. And I would love to start today's video by one sentence, and that is, there is some reason for being a setup. There is always some reason for being a setup. So make sure, guys, you have understood this video perfectly. If you need to watch this video 1 or 2 times more, please don't skip, okay? Because this is really a lot of information over here. When you are a beginner, the first job you have to do is you have to observe the price and you have to be relaxed. Don't force yourself for looking for a setup. Don't do that. Instead, always observe the price and get relaxed. Now, I would love to come here about the new day opening gap. What is new day opening gap? New day opening gap is actually the closing of, let me actually remove this one, later I will add that one. The closing of 5 p.m. in a specific day. So you can see not exactly 5 p.m. actually 4:59 p.m. It can be a down close candle. It can be a up close candle. You don't need to worry about that. You have to just mark the closing point, and you can use C on the bottom here. This is that horizontal ray. Just put an horizontal ray. Then label it by yourself. Whatever it is easier for you to remember, you just mark it. Label it by that way. You can see middle, right, then it will look like that way. And the opening to that same day around 6 p.m. So there is a 1 hour gap. 4:59 closing, 6 p.m. opening. This is your new day opening gap. This new day opening gap will be referred for 5 days, and you will separate that new day opening gap by 4 lines. Here, I would love to mark that 4 line. What is that 4 line? Just let me remove this one and instead let me mark it by this way. The upper quadrant, that is the 25%, and the lower quadrant, that means 75%. You have to mark all of this area, okay, and then extend it to your right for later using. How many new day opening gap you are going to mark and how many days you are going to use that new day opening gap? Every single week there will be 5 days of trading. So you will use that 5 days and you will see every single day if there is any new day opening gap or not. The same way you will mark all of them. Every single of the new day opening gap is extremely important. How long you are going to use that new day opening gap? In general, you are going to use that new day opening gap for 5 days. Now, not 5 weekdays, weekly 5 days like Saturday, Sunday. No, not like that way. 5 trading days. You are going to use that on. After that, are you going to remove them? No, there is nothing wrong to keep them, because after 2, 3, 4, 5 months, you can simply see that this new day opening gap is being reacted. But in general, as per ICT and also me, I am also going to use the new day opening gap just for 5 days. That means if this has created around Monday, I'm going to just count next 5 trading days. So either way, if it has created in Monday, the next Monday, I'm going to remove that from my chart. You please mark every single new day opening gap and keep them on your chart. What you can do, you can just make another layout and over there, you can just refer the new day opening gap only. Now, what is new week opening gap? The new week opening gap is the same thing like the way I have marked the new day opening gap. New week opening gap, you will mark the Friday 4:59 closing point and the open of Sunday 6 p.m. Okay, if there is a gap, you will mark that gap as a new week opening gap. How many days you are going to keep that new week opening gap? In general, you are going to use that new week opening gap for 5 weeks. Okay, it's in general, not like you can't use after that. I can't use after 5 weeks. No, it's not like, yeah, obviously you can keep it as long as you want. But in general, you are going to use that for 5 weeks only. Okay, new week opening gap. So this is the thing I have to clear over here about the new week opening gap. Now, when you have this new day opening gap, you just divide that new day opening gap or new week opening gap by 4 quadrants. The low, 75%, 50%, 25%, and the high. See, 1, 2, 3. These three lines should be there. As you can see, first market opened over there and then it went higher, come back again to the lower quadrant. Here, 75%. It tapped over there tick by tick. Then it went higher and you can see the reaction from these levels. Okay, it's the upper quadrant, lower quadrant, high, and the low. Also the 50%. Okay, now when market has traded that new day opening gap, finally it went higher. Look, this candle low and the open, there is a portion that is still open here. This is still inefficient. Okay, still this new day opening gap is inefficient, so market has an intention that later it will come back again to that specific area to fill that. Here, when market closed over there and opened over here, there was no buying or selling. There was no price action in between these two lines. No price action. Then market traded around that area, made it balanced. When it left it, it has made it balanced or whatever you say. After all of these things, market left that small portion open. When inside a new day opening gap or new week opening gap, you will see that there is still some portion open. You will simply think that this portion is very, very extremely important. That is your, the liquidity. Now it's not the liquidity, but in either way, this is the inefficient area where market will refer later to make that inefficient area efficient. Okay, you can see market finally tapped to this lower quadrant one more time, made the relatively equal lows. This low and that low, they are relatively equal lows. Then market has taken that relatively equal lows, went higher. I mean, that is a very nice displacement. After that displacement, market keep going higher by using the top of this new opening gap, tap over there. Then market went higher. Now, I would love to add one more thing. When is your day going to start? It is going to start around 12. I mean 0000. So this is the starting of the day, new day. That means before this line here, this is not the Wednesday price action. This is the Tuesday price action. After 0000, that means midnight. After midnight, my Wednesday session has started. So my day actually start around the midnight. Okay, exactly 0000. This is the starting of the new day. If you go to your daily chart, you will see that the daily low is over here. This is the daily low. Okay, but if you would love to mark that low from your daily chart, you are doing something wrong. You have to mark the low which has created after midnight. After midnight, the high and the low is actually your daily high or daily low. I thought it is important, so I just cleared that. Okay, so when market actually went higher and it has left that small portion open over there, then market went higher perfectly. How far it can go higher? Now it's not my concern to think about that because this is the Asia session. In Asia session, I'm really not interested about, about talking about the Asia session. Instead of that, I would love to talk about the 7 a.m. So here this is the 7 a.m. I have marked this one. This 2024 mentorship is all about the 7 a.m. the opening of the New York AM session, then 8 a.m. and the 9 a.m. It's all about this until now. So here I'm interested to talk about from there. If you have watched the episode 1 and episode 2, you already know that you are not allowed to see the price action before that area, before that line, before 7. Okay. So when market came here after 7 a.m., then what should you think where market is reaching for? First, if you have the new day opening gap open, I mean in below here, market is right now around 7 a.m. market is over there. You have an new day opening gap over there, which has some inefficient area. Simply, you will think that market will go toward that new day opening gap. Now, it can, it doesn't need to reach until that new day opening gap by today in that specific day. It can obviously reach over there the next day or maybe very after the very next day. It can do like that way. How do I know that market is actually reaching for that new day opening gap? You have to wait at least for 30 minutes around after opening 7 a.m. After opening 7 a.m., you have to wait at least 30 minutes to think that is market reaching for that new day opening gap. I'm going to add this new day opening gap with my episode 1 and episode 2. So from episode 1 and episode 2, you know that you will going to mark the relatively equal highs. Over there, I have this relatively equal highs and some kind of relatively equal lows around that area after 7 a.m. So there is no price action before 7 a.m. So over here, if I mark this relatively equal lows around that area over there. So this is my buy side liquidity. This is my sell side liquidity. All you can see that market went lower. When market is falling before taking the buy side liquidity, are you going to take sell? Because you are thinking market is reaching for this new day opening gap. No, you will wait until 30 minutes to see that if it can take the buy side liquidity, then it can go toward that new day opening gap or not. If you see no, market didn't take the buy side liquidity, then you just don't think that market is reaching for that new day opening gap, at least not now. So you will keep waiting for the price action, for the price signature that will tell you that market is reaching for that. So what you will see that market went lower, take the sell side liquidity, but didn't take that buy side liquidity. Then market came here to around 8 a.m. Then it started to go higher, and finally market has taken that buy side liquidity after 9. So this is the 9 open. After 9, market went higher and cleared those buy side liquidity. When market went higher, what it left? Now, after 9, you are able to use the price action until 7, not before the 7. What you should look for before the 7? In episode 2, not me, actually ICT told before 7, the only refer point is the London low. So this is the London low, this low and that low. They're relatively equal lows. I'm going to mark that as my sell side liquidity. If you would love to see anything just before 7 a.m., you should either look for London low. If you are thinking that market is reaching for that new day opening gap, then obviously you will look for London low. If you are thinking that there is some kind of new day opening gap high, new day opening gap above there, and you are thinking that market is going over that, then obviously you are going to mark London high before 7 a.m. Except that London high or low, you are not going to see anything else over there. Okay. So this is the London low. Remember, I just marked it as my sell side liquidity. What else do you have? When you have this buy side liquidity, what market left? This low and that low. They are relatively equal lows. Look, I'm not referring these lows. Okay. So you can see this low and that low. They are relatively equal lows, or maybe this is relatively equal lows. Maybe this is very clean lows. No, I'm not referring those. I'm referring the price action after 7 a.m. then wherever it is right now. I'm going to mark that on around that area because this is now my new sell side liquidity. So market came here, then it didn't take the buy side liquidity. So it is going to take that buy side liquidity. Which buy side liquidity? That buy side liquidity has created after 7 a.m. Okay, it's very important to understand the liquidity has been created after 7 a.m. That is extremely important for this mentorship. So when market has taken this buy side liquidity, now is the time you have to predict the movement. That means where market is reaching for, when it is going over there, and how it is going over there. This is the three questions you have to ask. If you understand the movement that market should take that sell side liquidity, which has created after 8 a.m. So around 8 a.m. it has been created. So every hour was 7 to 8, 8 to 9, 9 to 10. This 3 hour, the buy side liquidity, sell side liquidity is extremely important. By the way, guys, this is the wizard version. So whatever I have understood by watching ICT's video, I'm just explaining that. So in that 1 hour time frame where whatever buy side liquidity or sell side liquidity will be created, you will mark those, okay? And that is extremely important. So when market went higher, that is the Judas swing. Then market was consolidating. Here is the important part. You have to understand why market was consolidating over there. In this type of situation, you have to look at the calendar. If there is no news in the AM session, you are going to think that in morning session market is doing the more manipulation, and you are going to get the expansion around the PM session if there is any news. Now if you watch today's price, calendar, which is 7th August 2024 Wednesday, we had a news which is also not highly volatile but medium volatile news, what is called 10-year bond around 1:01 p.m. So we had a news, red folder news around, red or medium, I don't remember. I guess it was a red folder news, as it is not highly volatile. So I actually didn't give the priority over there. But we had a news around 1:01 p.m. So around the PM session, we are going to get the volatility. That should be your expectation. Okay. So around the morning session, market went higher. This is the Judas swing. How it is went higher? High. This high has been taken over there. Then this high has been taken over there. Then it left this relatively equal highs around that area. Look at the time where it left that relatively equal highs around 10 a.m. It's not important for me because the liquidity was important around 9 a.m., 8 a.m., 7 a.m. This is the liquidity around 7 a.m. If there is any kind of buy side liquidity around 8 a.m., this is the buy side liquidity, see, around 8 a.m. Then there was some kind of liquidity around 9 a.m. Look, this high and that high, they are relatively equal highs around 9 a.m. They are important. How this thing has been traded? This is relatively equal highs. That was relatively equal lows around 9 a.m. Look what market has done. It has taken this relatively equal lows, then it went higher and cleared those relatively equal highs, also those relatively equal highs. Okay. Now, as you know, that market is actually going to clear that relatively equal lows. Moreover, this relatively equal lows, which is actually the London low, and it is reaching for that new day opening gap. Why? Because market left that small inefficient area over there. So it is reaching for that small inefficient area. So you should think that this is the Judas swing and you are not going to participate as you don't have the news in the morning session. So you will wait. You will wait for the price action when it will start to fall. When it will start to fall, you will try to take the, you will try to participate in that price action. Now there can be a question, brother, I am going to mark every single new day opening gap. So there will be 5 new day opening gap. Maybe you are in Friday now, right? You are in Friday and you got 5 new day opening gap. In above you, there is 3 new day opening gap. Below here, there is maybe 2 new day opening gap. Which way market is reaching for? Which is the most important part? You will look for the inefficient. Which new day opening gap has left the inefficient area? The way it left that inefficient area. Okay. So over here, you see when it has made that new day opening gap, it traded until that area, then it went higher. So it left that inefficient area over there. If you have the inefficient area above the market, if there is 3 new day opening gap or 2 new day opening gap and they have more inefficient area, you will simply think that market is reaching for that new day opening gap. If you see below here, there is a 1 or 2 new day opening gap, but it has the inefficient area, you will simply think that market will go over there for that new inefficient area. At the same time, you will wait after 7 a.m. to see if you're thinking that it is going for that lower inefficient area. You will simply think that it will take the buy side liquidity, then it will go for that. Until it didn't take the buy side liquidity, you please don't think that market is going for that. Same thing, If you're thinking that market is going for that upper nude opening gap in efficient area, then you will wait to see if market can take the sell side liquidity first, then it will go for that upper nude opening gap in efficient area. One more information I would love to add over here. When market has traded that nude opening gap, maybe it has traded right over here, it has been traded that nude opening gap. Are you going to think that this is done? It has done its job? No, I'm not going to think like that. Instead of that, I would love to add over here. Obviously, this is from ICT. When market has traded some nude opening gap, when it has been traded over there, trust me, it's going to be very sensitive. Okay, the very next time when it will come here to this nude opening gap, you will get a some kind of obvious reaction from that nude opening gap. So when this nude opening gap has created over there, then later market has traded this nude opening gap, right? This is the first time market has traded that nude opening gap. Now this nude opening gap is extremely sensitive. I'm gonna keep this nude opening gap for 5 days. In the meantime, if I see market come back again to this nude opening gap later, maybe later some days, I will expect the reaction from there, because now this is extremely what to say, sensitive. So I am not going to think that as it has been traded over there, so it's done. I'm just done. I don't need that fair value gap. Not like that way. Okay. So I hope that that part of nude opening gap is perfectly clear about for all of you guys. I would love to add something else. Now, how do you know market is going to build the buy side liquidity, relatively equal highs or relatively equal lows? You can use that nude opening gap concept to predict that relatively equal highs or relatively equal lows beforehand. That means if you think that market is going to fall for that nude opening gap, you simply think first that market is going to make the relatively equal highs. So it didn't make the relatively equal highs around 7 a.m. It didn't make the relatively equal highs yet, but you are going to think that market is going to build that relatively equal highs, then it will take that relatively equal highs, then it will go for that nude opening gap. So you are going to predict when the relatively equal highs or relatively equal lows. Okay, vice versa. If you're thinking that nude opening gap is over here where market is reaching for, you will simply think that market is going to build some kind of relatively equal lows, then it will take that relatively equal lows, then it will go higher and trade that nude opening gap or the new week opening gap. Okay, so obviously that is important. So how you are going to predict relatively equal highs or relatively equal lows. Okay, now until this area, when everything is almost clear, I hope that everything is clear. So I would love to say one thing about this mentorship, and that is 1:30 p.m. The PM session is going to start around 1:30 p.m. Okay, so where is 1:30? Here. This is the 1:30 p.m. As per ICT. ICT doesn't give a shit if anything happened before 1:30. So he actually wait until 1:30 for looking for any kind of setup. If he missed something before, if there is a setup before 1:30 p.m., he just missed that on. He doesn't get worried, because he will have 2 p.m. because 2 p.m. is the silver bullet. So after 2 p.m., that means post 2 p.m., he is going to get some kind of entry or whatever he was looking for. He is going to get another opportunity to take buy or sell. Most interestingly, ICT has 81 PDRs. He has 81 PDRs. How many PDRs do you know? What do you mean by PDRs? I mean some kind of model. Okay, like breaker block entry model, then order block entry model, whatever it is. He has 81 PDR, man. That is really unbelievable. He can take entry depending on 81 model, but you don't need to learn all of them. Just be the master of any of them. Okay. If there is relatively equal highs and relatively equal lows, nude opening gap, comparing with nude opening gap, the relatively equal highs and relatively equal lows are more stronger for your bias. This is important. You have to understand. If there is nude opening gap and relatively equal highs. Which one is going to be more important? Obviously, the relatively equal highs is going to be more important comparing with new day opening gap or new week opening gap. In contrast, comparing the new day opening gap, new week opening gap with the normal fair value gap, some kind of this type of fair value gap, CB or BC. This new day opening gap or new week opening gap is much more stronger. They are much more stronger. Okay. I am going to explain the entry ICT has taken, which is around that area, because it is extremely important why he took that entry. He has explained that in his video. After explaining this entry, I'm gonna close today's episode 3, because I hope that you got the information what ICT has already delivered in his episode 3 about the new day opening gap, also the new week opening gap, and how you're going to predict by using 7 a.m., 8 a.m., 9 a.m. kill zone. It is clear to you. Okay. So around that area, we had a news 101. So I'm going to mark that news candle. So this is 101. Just let me mark it. Oh, sorry, 101. Where it is. Just let me mark it. This is the news candle. Okay. So before this news candle, he has this sell side liquidity. Which is this sell side liquidity? The London low. Okay. Remember the relatively equal lows. This is the London low. And market, you can see market after taking this, after clearing these highs, relatively equal highs, market actually fall and take those relatively equal lows. You can say why market is not going to take this buy side liquidity. The reason is market was bearish and it has to reach for that new day opening gap. It has already done a lot of manipulation over there. It doesn't need to do more manipulation. The real manipulation was over there, that relatively equal highs. Then when it has been done, then it doesn't need to do more manipulation, then it fall. Okay. Finally, my ICT has taken an entry to that specific area. How he has taken that entry? When market fall dramatically around that area, okay, it will fall that area, leaving that buy side liquidity. So this high and that high, they are relatively equal highs. You are not going to think that market is going to take that buy side liquidity. Why? Because you know market has already changed its bias. See, it is bearish now, extremely bearish, and it is reaching for that new day opening gap. More specifically, this London low, and also it left that single low. Okay, so all of this is going to be your sell side liquidity that is market reaching for. When you have this line, that London low and the new day opening gap inefficient area, and finally market came here, then it fall dramatically. He was looking for this fair value gap. So let me mark that fair value gap here. This is that fair value gap, and he was looking actually. Let me change the density. Let me remove that. He was looking how this candle is going to trade. If it doesn't trade that constant encroachment, if it failed to trade that constant encroachment, then the candle will close below this candle. This is the bearish order block. This candle has made that bearish order block valid. Okay, so he took his trade or entry when it tapped to this order block. Then market fall, come back again there. He took re-entry to that specific candle because it has rebalanced, immediately rebalanced to that specific candle. Now, after pyramiding his entry, market went little higher. He didn't give, he wasn't worrying about that, because he knows you have to mark every single bearish fair value gap. When you know that market is falling, you have to mark every bearish fair value gap until some specific relative, liquidity. In episode 1 and episode 2, ICT has cleared. Also, I have cleared by the wizard version. Whenever you are thinking that market is falling, you have to mark every single bearish fair value gap and you have to extend it to your right. Okay. So you can see market failed to trade that constant encroachment. What if it has traded that constant encroachment? What if? Then market ICT would wait to see market will take that high to take the buy side liquidity. Then he would start to look for sell. He wouldn't push his button from that order block. Now this order block is actually showing him the weakness, because market even failed to trade that constant encroachment. There is another fair value gap. See, he wanted to see this is going to be as a breakaway gap. That means market is not reaching for that one. And this is the sign that market failed to trade that constant encroachment. This is the sign that market is not reaching for that. If market trade that constant encroachment, then he will try to take his entry from the upper portion of this fair value gap, and he's going to cover his stop loss to the constant encroachment of that specific fair value gap. Okay, so he is going to cover that constant encroachment. He is going to think that market is going to take that sell side liquidity. Why? Because you have a news around 1:01 p.m. So this news drive will send the price until that liquidity London low, more specifically until this inefficient area inside that new day opening gap. That helps him to be confident to push his button to that specific candle when he saw the weakness over there. Then he added over there. Market went little higher. Where did it go exactly? To that bearish fair value gap. Did it trade that constant encroachment? No, it didn't trade that constant encroachment. Market fall again. When market fall again, here you will see the 22 YT model. So over here, let me mark the fair value gap over there. So this is the fair value gap. One candle went little higher of that fair value gap, right? It went little higher. That is the mohawk. This is the mohawk. Market went little higher, trade that bearish fair value gap, then it fall again. Where it has fallen? London low. He has closed his trade when it tapped to this London low, which is actually the real sell side liquidity. Okay, so that was his entry. Here, this is the optimal trade entry or 22 YT model, whatever you think. That was the entry opportunity. If you didn't push your button to that order block, which is one of his 81 PD array, if you didn't push the button over there, you can push your button over here by believing that around 1 p.m. when market has made that bull candle, to that specific bull candle, the traders started to think that now market is going higher. But what market has done? Fall dramatically again, shifted the market. See, this is the market structure shift. Here is your fair value gap. Trade that fair value gap. It fall again dramatically. Where? Exactly to that London. So guys, that was the episode 3. All the information I got from ICT's video, I have delivered it to you. If you think that it is insightful for you, don't forget to give me the thumbs up and don't forget to subscribe to my channel. If you are new, most importantly, give me the feedback. Don't appreciate. Please don't appreciate, okay? Just give me the feedback. No, brother, it was not good. It was good. You should talk about that more, or you should make it more, shorter, this video. Just let me know that, okay? So until the next video, cheers.